Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook. All right, I guess the big headline today was CPI, and I may be saying big is a little bit overdoing it. The markets right now are a little bit bored. The SPX is up about 1/3%, and we got the Russell down a smidge, about 1/4%. And then let's look at the NASDAQ. NASDAQ is up a little bit, almost 0.5%. So it's leading the way right now, the NASDAQ is. So kind of muted news from the CPI. It is the big headline would be that it's the highest print that we've had on the CPI since August. Let me say that again. It's the biggest monthly gain of 2023, the announcement in August. So I kind of screwed that up. But bottom line is, what did it do to the Fed and the probability of them raising interest rates going into the meeting here at the end of the month in September? And it did absolutely nothing. The market was expecting about 8% chance that we would raise interest rates 1/4 point on the Fed funds rate. And now it's down to about 3%. Looking out to November, which is a little bit more interesting at this point. So looking at the CME Fed Watch tool, it's saying that we have about a 39% chance of a 1/4 point hike. And that didn't change much. That was right a little bit above 40 prior to the news. So I guess if anything, it came off a little bit. Has a lot to do with energy. And on Options Guy TV, we've actually did quite a few bullish trades on energy on the USO in general and how we would play the energy market. Also looked at a couple of energy stocks. So that is the biggest driver of the increase in CPI, and the market doesn't seem to be too worried about it. Not a lot has changed as far as the futures markets are concerned on the Fed funds rate. Now, I also took the time to actually scroll out a little bit. If you go to the CME tool, you can actually see where the markets are at going into 2024. So you can go January, February, March of 2024. It obviously becomes a lot less interesting, I guess, or predictive to be that far out in time. But the first real chance of a rate cut appears to be in March of next year. There's a 20% chance that the markets may cut, or the Fed may cut the Fed funds rate by 1/4 point in March at this point in time. Now, they also have a 30% chance that they may raise. So that's what I mean by it gets a little bit muddled when we go further out. But I was really interested to see what the futures market is saying about when we might see a cut in the Fed funds rate. And so that's not too far into 2024 where that possibility is there. So what have we done recently? I think that some of the strategies have had a similar outlook as the market in that they've been a little bit convoluted. On Monday, we tried to find some value looking at Caterpillar, and we did a fig leaf in Caterpillar. We'll go back and we'll just take a peek at that trade today. But that was one way to get a little bit more long-term bullish on a strong industrial company like Caterpillar. And mainly because it's I don't really want to get long almost anything at this point in the September time period. But we do look at the VIX, and we highlighted on Monday that the VIX was actually up, maybe because of the CPI, but it was up on an up market. We had some fall off. Once again, we're just back to chop. And that's really what the market is doing. I think we want to get through September and October before before the market decides what it wants to do. The Fed meeting here that's going to start on September 20th. Actually, and I want to point out, we're going to have a guest speaker here on the 20th. Russell Rhodes, a good friend of mine that I used to work with at Chicago Board Option Exchange, the godfather of the VIX index, basically, or he's written more books on the VIX than anybody out there, that's for sure. And we're going to talk about big movements and volatility on that show around big news events, not only in indexes but in stocks. And I'm very excited to have Russell to show here on Options Guy TV. So mark your calendars. That's going to be Wednesday the 20th, and right ahead of, perfect timing, right ahead of the Fed's meeting about the Fed funds rate, and potentially probably going to come in with a very uneventful day, in that it doesn't look like they're going to be raising rates, or not too much to offer on that day. But we're going to dive into volatility, talk a lot about the VIX, talk a lot about movements after earnings reports, movements after big news events and indexes, and it's going to be a lot of fun. I always enjoy talking to Russell. He really he's one of the only people out there, one of the only authors that was willing to actually take the challenge of trying to explain the VIX index in detail in a lot of his strategies. Okay, so the VIX is off a little bit. We got the markets up a little bit, but the VIX is down about 67 cents. It's trading at 1356. And I've mentioned this more than once, is that the end of the budget for the government is going to be happening at the end of this month. And hasn't been as much news about it, like the debt ceiling, and the fact that there was a potential to shut down all branches of government without raising the debt ceiling. Congress was able to pull that off, but now we're back to budget talks. And I think there should be a little bit more concern about budgets not getting approved, and that would only affect certain areas of the government. But that still is I think it's the one little landmine that is out there in September that could add more volatility to the marketplace. It might just be that one catalyst that can drive the market south. So I'm a little bit more nervous about that. Surprised to see the VIX at the level that it's at. And we actually have a trade on that's going to be expiring on the 20th in the VIX. So we'll probably look at that trade on Friday. Whew, all right, so that's a lot. So as promised on Monday, we're going to look at Adobe. Adobe is part of the AI world. It's obviously not the NVIDIA, but it's up about 67% since the beginning of this year. So very strong numbers. We've had a couple upgrades in Adobe this week going into earnings. And right now we see the stock trading at $553.90. It's actually up 2% on the day, or up $11.69. Now, we tape Options Guy TV at 11 a.m. Monday, Wednesday, and Friday. Adobe's going to be announcing earnings on Thursday after the close. So I might adjust my trade that we're going to talk about today, our paper trade that we're going to do, a very speculative trade around earnings. But the same principles would apply. So our official paper trade is we're going to be doing a butterfly, but I want to talk a lot about how we're going to set up that butterfly. Okay, so if I look at the expiration dates that are available, let's run to the TradeHawk software and look at the options grid, and let you know that if you have any questions, please put them in the chat box on YouTube. You got to be on YouTube in order to ask some questions. And if you have any, please address them. We'll address them during the show, at the end of the show, but we want to make this as interactive of a show as we can here on Options Guy TV. So September 15th is 2 days away. Now, I'm going to look at this trade first to start with and look at where the most at the money option contract is. So right now the market's at 553. I think I would look at the 555s. I guess the 552 is close. So you look at where the ask is on the call side and where the ask is on the bid side, or you know, somewhere in the middle. It's not an exact science, but we want to know where the expected move is. When I did that earlier, it was trading the long straddle was at 29.40, which is about a 5% expected move on Adobe. And after a big run up like this, I think that's a little bit of a muted move. Like the potential could be bigger. If I wanted to bet the over under on the move, I think I would take the over. And that's where the expected move comes from. It's all about, this is what the market is pricing in, that a potential move by that Friday expiration. I always want to emphasize too that that's 2 days. That's including today's trading, all day tomorrow's trading, and all day Friday's trading. So a lot of people build this as after earnings, but it's a little bit more than after earnings. But with that said, when I'm looking at that expected move, I want to use that to try to set up the strike prices that I'm going to use on my strategy. Now, based off of kind of what happened with Nvidia, which we did a trade in also around earnings, I kind of looking for the sell-off, but in Nvidia, they blew away earnings. The market wanted to sell off after the earnings report, but literally couldn't because the numbers were so good. So what ended up happening in Nvidia is you had a big run up after they blew the numbers away on their earnings report, but in a few more days, it took some time, and the market did end up selling off. So picking the expiration was very important, as usual. And a lot of times when I'm looking at these butterflies around earnings, I like the fact that they announce on a Thursday, and then on a Friday, you have 1 day's worth of trading, and all the time premium and implied volatility have to come out on these expensive stocks. And so it's an interesting dynamic of option pricing. And if you are right on your forecast on a butterfly, you need time premium to go away because you have sold 2 option contracts that would be at the money if you're correct. And you need to be able to buy those back for as little as possible. So hence implied volatility coming in is good. Hence time decay is good. Okay. So I'm going to change it up a little bit. I'm going to look at the September 20th expiration. I'm highlighting it on my screen right now. And we're going to go out 9 days and we're going to set this one up. And, only because we want to do stuff differently. We want to learn here on Options Guy TV. Most of the time I would do it very short term, but we're going to give it an extra week. And then that also allows us to potentially adjust this trade. And I may do an adjustment if we are incorrect on our forecast. If I go 9 days out, the downside is that we just don't get rewarded as quick. If we are correct on our forecast that the market will go down, that it's a little frothy here, even if they meet earnings expectations, maybe you might see a little bit of a sell-off. We had two different upgrades this week. I didn't write down who upgraded them, but that has made the stock actually rally going into this earnings. Okay, so even adding a little bit more froth into Adobe and the marketplace. So here's our trade. Right now we know that the expected move is about 30 points down. So I always like to pay a lot of attention to the expected move and also the 1 standard deviation move. And it's very easy inside the TradeHawk software and the options grid because we will highlight where a 1 standard deviation move is at. So in this instance, if you go down 30 points, the 525 strike is in play, and the market was at 555 when I was looking at it. So now it's 525. And that's about 30 points away. So the first strike is within the expected move, and that's planned, right? I want to be able to buy a put. I wouldn't mind buying a put outright in this scenario, but it's expensive. If I were to buy that 525 put, I'd have to pay, and I'm highlighting it on the screen, $6.50 or $650. Now, I wouldn't mind it coming down to that range, but I'm within that 1 standard deviation or within that expected move. Then if you keep going, and remember, we're in the September 22nd expiration, 9 days away. The expected move to go out to that date is all the way down around the 1 standard deviation move is down to the 505 level. So if I look at that now, I'm within a 1 standard deviation move, which is still plausible, not probable, but it's still plausible. So we're right around the expected move. That's where we're buying the put. We're selling the call or the put options around the 1 standard deviation move. And then we're going out and we're buying our protection another 20 points down to set up a standard butterfly. So if I'm looking at doing a butterfly on an expensive stock, I'm always going to apply these scenarios. I want to buy a put or a call. I mean, if I'm a little bit more expecting more volatility than less, expecting more move than the expected move, because volatility is tied in to the expected move, then maybe I might adjust it. But if I want to take what the marketplace is giving me, the information that the marketplace is giving me, this is how I want to go and set up this trade. This is that simple. All right. So I'm going to look at the 9-day trade, and then I'm also going to look at the 2-day trade, which is that September 15th expiration, and just so that we can compare and look at prices. If I go up further in time, there's more time premium on the option contracts that I'm selling, and that will usually make the butterflies cheaper, and that's normally the case. It's harder to predict where the market's going to be 9 days from today as opposed to 2 days, right? It's harder to, you have more time for the market to actually come down to our price and then go away from the price. And that's kind of the concept that's behind it. So usually longer term butterflies have more time frame. They're going to be cheaper. And that's going to be the case here. So here's here's why we picked the strikes. Here's what we did. Now I'm flipping a coin to say that we're going to be bearish on it. All I'm doing is kind of following what has happened in the AI space. Everything has been so strong on the upside that earnings is a opportunity to try to sell off some things. I guess we have a big meeting that's going on right now with a bunch of government officials to go along with Elon Musk and a whole lot of industry people, including the CEO of NVIDIA. And so that who knows what's going to happen after that meeting, right? What might come out of it. All right. So a lot going on. So if I look at this trade and I set it up, I highlight it here. This shows me the spread legs. We're on the put side of things, 1 by 2 by 1. Go down here. We show that we are that expiration on the 22nd, September 22nd, 9 days away. Our order ticket is down below. And we're going to do a 20-point wide butterfly and get that trade done for $1.95 on the midpoint. If we can get it done on the midpoint, it'll be $1.95. Looks like the markets came down a little bit, so now it's changed. I guess we'll make it more real. We'll go 210. We'll say 210. Not happy about that, but the trade's already up 15 cents. So $2.10, or for every 1 by 2 by 1 butterfly that we put on, our cost would be $210 plus commission, and that's going to be our maximum risk, as opposed to just buying this put outright, which would be maybe an alternative. You could maybe look at doing a spread, but then you're paying $6.70, or maybe you just do the spread. You buy the 525 and sell the 505s. Those are potential alternatives around earnings. I'd rather do a butterfly, sell some more premium, have a little bit more, a little less risk overall, just because the net debit is lower. Okay. Now let's change this up, and we can, well, first of all, let's look at the what if chart, and then we're going to come back and we're going to send this to the what if calculator inside the TradeHawk software. And this shows you that this is where the market is at. To start with, the green line is showing the profitability potential based off of this implied volatility ahead of earnings and based off of 9 days remaining to expiration. So if you're correct on your forecast and it goes down to your short strike, you don't get rewarded right away. You need some time decay. You need some volatility to come off. You would be up on your trade, right? We paid the $2, and the yellow line is highlighting that at expiration, the $2.10. I think that's where we ended up at. And yeah, there it is, 209. Okay. So at that second, we're down $2.10. If the market keeps going on up, when we get to the middle point here, right, of the strike price, we are up on the trade. But as time decays and implied volatility erodes, you will start to see the green line, which is as of today, start to morph into the at expiration line. Hence the reason sometimes we like to do these with the 1-day option contract after they announce earnings, because if you are correct on your forecast, that time decay is expedited and implied volatility comes in, and it's expedited on the crunch on implied volatility. So with that said, if you're going to be correct on your forecast and it's going to move more than the expected move to the downside, you would rather be in the shorter term option contract. We're going to do this trade a little bit longer term, which also means that if the market does go against us, we got an opportunity to adjust it. If you're doing the short term trade, it's basically over with. Once the earnings announcement happens and the move happens, you're going to have, and if you're incorrect on the direction of the underlying stock, this will just collapse and everything will just go away. And basically, you'd lose whatever your investment was. Okay. So that's how the profit and loss graph looks. Let's go back and look at the trading. And I do see a question here. So I guess let's address this question, and then I will go and look at the 2-day butterfly, the one that was talked about more often here on Options Guy TV. So let's put that question up. All right. So the question is, do you ever trade butterflies on stocks after they announce earnings? Yes, I would. And Adobe might be one of the stocks that I would consider because it's an expensive underlying. And the expensive underlying, especially if you look on a 1-by-2-by-1 basis, has those same type of dynamics where you're going to have increased option prices just because the underlying is more expensive. And also, you're going to have high rates of time decay because of those increased prices. So if you're looking on a 1-by-2-by-1 basis, Adobe would be a stock that I might consider doing a butterfly in. But with that said, I would more than likely try to pick a direction and either look at a long call spread or just a flat out long call. You're not looking for the big move. You're not trying to really reduce your costs because you're worried about implied volatility, crunching, and those type of factors. So I would be more apt to use butterflies around earnings and look at long call spreads or long put spreads after that earnings announcement. So thank you for that question. Very solid question. All right. If you have any more, please put them in the chat box and we'll be happy to try to address them before the end of the show. So now all I want to do is look at the price of the butterfly and show you what happens if we go a little bit more short term. So on the 2-day option contract, and all I'm going to do here is I'll click on this. All of this will go away because we're no longer in that September 22nd expiration. And we're now in the 15th expiration. The one standard deviation move is going to change. A lot of things will adjust. But if you want to just adjust the trade, all you have to do, and we're going to leave the same strikes because it's based off of the expected move on the shortest term expiration. All I'm going to do inside the Trade Hawk order ticket is move the expiration date. So we're on 9/22. We're going to go to 9/15 and 9/15 and 9/15. And what's nice about that is it just adds the spread legs over here on the graph. Now, it's adjusted things a little bit, right? Because the one standard deviation move is now at 5/15 because we have a shorter time period for these option contracts to live. So that will adjust the one standard deviation move. On the September 22nd, we're at 505, which it's neither here nor there. But we do want to know what the expected move is on the shorter term options right around that earnings report. All right. So now if we do this trade, we're trading at 194. So in this instance, with these same strike prices, the markets came down a little bit. We're really not getting a big break by going to the shorter time period. We're paying 190 for that trade. So our overall risk would be $190 for every 1-by-2-by-1 butterfly that we're doing. But if we looked at the longer term trade, where's the market at? 153. I think it was fairly close. We were at 205 on that trade. So you're talking about 15 cents difference to go out another 7 days to that expiration date. So if you want to, you can do this trade. You don't get a ton of benefit as far as the pricing is concerned, even though you're going a lot shorter on that expiration date. But if you are correct on your forecast, you will be rewarded much quicker on that September 15th expiration date than you would on the September 22nd expiration date. All right. So we are getting close to the end here. If you have any other questions, please do put them in the chat box. If not, let's take a quick peek at what we did in Caterpillar this week. So if I pull up a chart in Caterpillar, and I'm going to run to Cat right now and look at the trade. Let me go back and look at my notes here just a little bit. So what has happened in Caterpillar since Monday is we actually had a decent run up in the underlying stocks. Let me grab this little corner. So we actually did have a couple of solid up days in Caterpillar, and now we've came back down. So the high here was 284 right here. If I just put my cursor 284.87, and then it ended up on the down day. But we did have a decent run up. And what day did we put this trade on? We put the trade on the 11th. So here's where 9/11 was, right here. Okay, so we ended up on a down day. Then the next day we got up to 285, and now we're trading right at 280. So we're right about where we were. No reason to have any concern on that trade. We sold a call option because we were worried about the chop that was going to be in the marketplace. But with Caterpillar, very simple, straightforward trade. We paid when we did the trade on Caterpillar, the stock was trading at 280.79, and now it's 280.44. So we're down $1.30. We're 280.44. So if anything, we're getting some good time decay on our option contract. The option contract that we sold was the 292.50 call option, and the one that we bought was the 230 call option, and that's going all the way out to June. And then also, if we went and look at our Q trade, we bought an out of the money put on the Qs. VIX was trading a little bit. Well, it was pretty much flat, I guess, from when we put it on at. The Qs were at 374.06. So this was our kind of a protective trade that we looked at. And our expiration date on the Qs is going all the way out to October. So looking for that volatility period in September and maybe in October. The 368 strike put was trading for $5.54. And the market is actually up 1 point since we did this. So the market was at 374.06. And right now it's at 375.06. Not much. Might affect the price of the option contract maybe by a quarter or so, but we would just be looking to stay the course. Biggest thing with the Qs is if we do get a decent move down, 2 or 3%, maybe 4%, we'd look at selling a call and rolling that into a long put spread. All right. Well, that's it for this edition of Options Guy TV. Please click subscribe, ring the bell, pound that thumbs up if you're liking what you're hearing, and we'll do a little bit more of it here on Options Guy TV. And we'll be back this Friday to look at what happened with our trade in what happened with our trade in Adobe and any adjustments that we may do on that trade. So thanks for coming, everyone, and we'll see you this Friday at 11 a.m. for the next edition of Options Guy TV.